The year is 1929. You're making some money in the stock market. You buy a share of General Motors at $49.25. And then boom, the market crashes. You check your portfolio and find that your $49.25 is now only worth $18.90. What happened? How did this crash happen and why? Well, in the early 1930s, people were getting into the stock market like never before. The problem was there were no strong rules, so some people cheated. They spread false rumors to pump up the price of certain stocks, and then sold their shares for a big profit. When the market crashed, people lost billions of dollars. People needed a way to protect their investments. So on June 6, 1934, President Franklin D. Roosevelt signed the Securities Exchange Act into law. This act made it illegal for companies to lie or to cheat when they sold their stocks. The law also created a watchdog agency to oversee the stock market and protect investors from con artists. This agency was called the Securities and Exchange Commission, or the SEC, and it's still around today. The SEC works to keep the stock market fair and safe. What does the SEC do exactly? Well, first, the SEC requires companies to tell the truth about their business when they sell their stocks. Companies must reveal all the important facts about their finances, like how much money they make and how much money they owe. If a company wants to sell stock, it has to file a registration statement with the SEC. This tells the SEC and the public important facts about the company and its stock. The SEC reviews this information to make sure it's complete and accurate. Second, the SEC requires companies to follow accounting rules. These rules ensure that a company's financial reports are reliable and that they follow the same accounting rules as other companies in the same industry. For example, if a company wants to take a loss in one year, the SEC requires them to save money for that loss in a special account. That way, the company can't make a profit in one year by taking away from the next year's profits. Finally, the SEC prohibits insider trading. That's when someone uses secret information to make big trades and get rich. For example, if a company's CEO knows that their company is about to be bought out, they can't use that information to buy up the company's stock and make a ton of money. That would be unfair to other investors who don't have that kind of information. So next time you hear about the stock market, remember that it's not just a bunch of people on Wall Street buying and selling things. It's a marketplace where companies raise money so they can grow and create jobs. It's also a place where everyday people like you can invest their money and build wealth for the future. Thanks to the SEC, we can feel confident that the market will be fair and safe.